What's up, traders? So today I'm going to show you how to build your account using credit spreads. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from the stock market. And I have a wife and 6 kids, and I use the money I make from options in order to pay for our entire lifestyle. Now, I currently trade out of 7 different accounts, and these accounts range from anywhere on the small side of $6,000, and the largest of the accounts are multiple 6 figures. And I currently still utilize credit spreads in my smaller accounts, and the accounts that are multiple 6 figures I built up using credit spreads and iron condors. And I really started off my options journey utilizing credit spreads. For those of you not familiar with my story, about 9 years ago, I was working at a job making $10 an hour. And over the course of several years, I saved up enough money in order to start my own ice cream business. And for several years, the business did really well. However, when the 2020 pandemic happened, I was forced to shut down. And because at the time, no one knew when this pandemic thing was going to be over, I needed another source of income in order to provide for my family. And I'd already been investing for a few years, so I decided to try options trading. And so really, it was almost out of desperation that I even started trading to begin with. And from there, I started building the process that I use today in order to trade options to bring in multiple 6 figures a year. But when I started, I would have never imagined that I would be where I'm at today via options trading. But one thing's for sure and two things for certain, his plan is always better than our own, and he is good all the time, and I'm forever thankful. But please, before we get started, make sure you like and subscribe this video. That would literally mean the world to me. And do remember that this is not financial advice, and I am not a financial advisor. I'm just showing you how I've built wealth over time. But with that being said, let's get down to business. So the first part of this video, I'll be showing individuals that are newer to options trading how credit spreads work. However, if you are more experienced with options trading, make sure you stay to the end of the video because I'll show you a better way to utilize credit spreads. Now, with credit spreads, the objective is to generate income from a stock price staying either above or below your strike price. So credit spreads is an option selling strategy. And typically about 90 to 95% of the time, I'm an option seller. And the reason for that is I like the high probability of profit. And I also like the reliable income. Every single week, I know exactly how much money I will be bringing in via option selling. And if you're someone who wants to boost the income that you make from your 9-to-5 job or even replace it, you need to know how much money you're making and when. And you need to know that it's consistent and reliable. And so that is why I'm an option seller. All right, but you may hear credit spreads often referred to as vertical spreads as well. And there are 2 main types of credit spreads. So you have a bull put spread and a bear call spread. Now, a bull put spread is when you believe a stock price will stay above a certain point, and a bear call spread is when you think a stock price will stay below a certain point. So an example would be if ABC stock is currently trading for $120 and you believe that it will stay above $100, then you can open up a bull put credit spread. And on the flip side, if you believe that that $120 stock will stay below $140, then you can open up a bear call credit spread at those prices. Now, the key components of a credit spread is you sell one option and you buy another with the same expiration, but different strike prices. And so if we use the example of ABC stock that I just used previously, if the stock was trading for $120 currently, what we could do is we can sell a put at $100 and then buy a put at $90. And that would complete your bull put credit spread. And as long as ABC stock stayed above $100, you could make money off of that trade. But let's look at a more specific example. All right, so in this example, we have a stock price that is currently $80. And what we did here is we sold a put at $75 and we bought a put at $70. Now, for putting on this trade, we received $100. Now, that $100 is the maximum amount that you can get off of this trade. Now, on the flip side, your max loss when doing credit spreads is always the difference between your strike prices times 100 minus the premium you received. So in this case, the difference between our strike prices is $5. And then 5 times 100 is 500. And then if we minus the amount of premium we received, which was $100, that puts us at a max loss of $400. So that $400 is the maximum amount that you could lose off of this trade. And so while your max profit is capped, your max loss is capped too. So it's good because you go into the trade knowing the worst case scenario that could happen. Now, on the flip side, we have the bear call spread. So if we were to have a stock that was currently at $65, then what we could do is we could sell a call at $70 and then buy a call at $75. And for putting on that trade in this example, we received $100. And again, our max loss is capped at $400. And so in this case, the trader believed that the stock would stay below the $70 strike throughout the duration of the contract. Now, the benefits of selling credit spreads, like I said at the beginning of the video, is you have a low cash requirement. And so credit spreads are great for people with smaller accounts because the max loss is the amount that your brokerage will require you to have in your account. So in the previous two examples, my max loss was $400. So that is all I would need in my account in order to put on that trade. Now, some brokerages require you to have at least $2,000 in your account to get approved for selling options to begin with. So just make sure you keep that in mind. And so secondly is limited risk. So as we talked about before, your max risk is the spread width minus the amount that you received. And then thirdly, time works in your favor. And so that is for any option selling strategy. Now with options buying, time works against you, but credit spreads are option selling strategies. And with option selling, you want to receive as much as possible up front and pay the smallest amount back. And with that, you get to keep the difference. And because time value is a huge part of an options premium, as time value continues to decay, an options contract becomes worth less and less and less. And as an option seller, that is exactly what you want. All right. And lastly, and probably most importantly, you can generate consistent income with credit spreads. Now, what are the risks of selling credit spreads? Well, it's limited risk because you get to choose your strike prices. And it's all dependent on how wide your spreads are. So in the previous two examples, I showed you a spread that was $5 wide. However, with certain stocks, you could pick spreads that are as little as $1 wide, and you could theoretically do spreads thousands of dollars wide. But the width you pick for the trade will determine your max loss. And the second risk is over leveraging yourself. What I see a lot of newer traders do is they get into the stride and they think that it's just easy money and they do more contracts than what their account can afford. And you don't want to risk your entire account on one trade. So we want to make sure we don't over leverage ourselves. Now, as far as managing the position, this is a great trade for people who are busy. This is not something that you need to stay in front of your computer and watch all day. All right, pulling your phone out and checking it in the morning and then checking it again near market close is good enough. And depending on the stock, I'll normally exit the trade anywhere between 50 to an 80% profit. Now, before we go and open actual credit spreads, we need to go look for the stocks that we want to trade. And in order to search for the best stocks, I'm going to use an online screener. So here we are at the online screener, and there are three things that I used as my criteria. And so the first one is the implied volatility. So implied volatility just measures how much the market expects for a stock to move. And if it's expected to move more, the implied volatility is higher. Well, what happens when the implied volatility is higher, the options premiums are greater, which as an option seller, that is what you want because you collect more money up front. And then secondly, I want the stock price to be at least $10. I'm not interested in trading like penny stocks or anything of that nature. And then for me personally, I want the market cap to be at least $30 billion. I just prefer to trade larger, more established companies. But now that we have those things set, I'll hit see results. And the screener came up with 21 different companies. And if we look at the list, we have Tesla, Palantir, ARM, Arista, Shopify, AppLovin, Spotify, and many more. But looking at this list, I see three companies that I've traded before or I trade pretty often. And that is Tesla, Palantir, and MicroStrategy. And so now that I have that information, let's look at the first data point that I use in order to select the best strike price. So here I have Tesla's chart pulled up. And the first thing I want to look at are the Bollinger Bands. So if you're not familiar with Bollinger Bands, they are these black lines that you see here. But the Bollinger Band just aims to show you the range that a stock price is expected to stay within. And usually it's about 95% accurate. And so we can see here at the lower end, the Bollinger Band is currently expecting Tesla to stay in a range of $387 up to $428. And so now that we know that, let's head over to Thinkorswim and look at our second data point. But wait, are you ready to stop trading time for money? In my community and course called Trader Freedom, I will show you how to make money work for you using stock options. I built a life of financial independence supporting my wife and 6 kids entirely through options trading. And now I want to share that with you. This course gives you everything you need, step-by-step strategies, my real-time trades, and full access to me to create a steady income stream that doesn't depend on your 9 to 5. If you're ready to take control of your financial future, let's get started together. The link is in the description below. I'll see you soon. So here we are at the options chain of Tesla. And the next thing we need to do is select our expiration date. Now with option selling strategies, I always select an expiration date within 45 days. And the reason for that is time value starts to decay even faster once we hit the 45-day mark. And so 45 days is my max. However, my max is exactly that. So I may go 7 days out, 14 days out, 25 days out. They're all on the table. I just need it to be within 45 days. And so for this example, let's go out exactly to the 30-day mark. So this expiration here is 30 days out from today. So I'll go ahead and select it. And let's assume that you're bullish on Tesla. So we will enter in a bull put credit spread. So I'll come over here to the put side. And the second thing that I want to look at is the delta. So the delta is the column here. And the delta shows you how much an options premium will move for every $1 move in the underlying stock's price. So if we scroll down here, we can see at this strike of $355, it is a 0.15 delta. So that is saying for every $1 move in Tesla's stock price, the options premium for this strike will move 15 cents. Now that is what delta is by definition. However, most successful traders use delta as showing a probability of an event occurring. So at that exact same strike of $355 with a delta of 0.15, I would look at that and say there's about a 15% chance that Tesla's stock price, currently at $420, drops down to that strike price of $355 by this expiration date 30 days out from today. All right, so I use delta as the probability that the event occurs. At a 0.15 delta, that means I have about an 85% probability of profit. Now, when it comes to delta, I typically now select a delta of 0.20 or lower. However, when I had a much smaller account, I would go all the way up to a delta of 0.30. So let's look at this options chain. And I do know that as of the date of this recording, Tesla has earnings next week. And because of that, all of the options premiums are going to be much higher because there's a huge event such as earnings already priced in. And so because of that specifically, I want to be a little bit more conservative when selecting my strike price. And so while I would make much more money by coming up to this delta of, let's say, 0.30, which is at the strike of $390, it is much better to be more safe than sorry, especially dealing with earnings. And so let's go ahead and select that delta of 0.15. All right, so that strike was $355. And so what I can do is I can right click, go to sell, and then go up to vertical because a credit spread is a vertical spread. So we'll click that and we can see it auto populates the $355 short strike for us. But now we need to select what strike we want to buy to open as well. And just remember, whatever strike you pick to buy to open will determine how much risk you're taking on. And let's say for this trade, we're willing to risk about $3,000. Well, if I already know that beforehand, then I know that I need to select a strike that will give me about a $30 width. So 355 minus 30 is 325. So I'll select 325 for my long strike. And now if 3,000 is the max that you're willing to risk, you can just keep this one contract. However, if you have a larger account and you want to do more than that, then you can just come over to this contracts area and add as many contracts as you like. But just for the examples of this video, let's keep it to one contract. And the mid price for the premiums is currently $4.12. Now every option is worth 100 shares. So the price you see here, you'll always times that by 100. And that'll be the amount that you receive. So if we go ahead and hit confirm, if we take a look right here, we can see that our max profit from doing just one contract of this trade will be $412. And below our max loss would be $2,588. And that is because the width of our spreads was $30. And then we times that by 100, which will get us 3,000. And then you minus the premium that you received, which was 412. And that gets us to a max loss of 2,588. And because we selected a delta of 0.15, we have about an 85% chance of making money on this trade. Now let's look at the profit and loss diagram so you can see how much money you can make or lose depending on where the stock price falls on the expiration date. All right, so here we are at the Analyze tab of Thinkorswim. And you can see I have the trade that we just made pulled up. And here is Tesla's current price right here at $418. And all we need in order to stay profitable is for the stock price to stay above this strike of $350 by the end of the expiration date. Now, what I want you to do is pay attention to the blue number that you see at the bottom left here. So this will show you how much the trade will be worth at expiration. And so the x-axis here is the price of the stock, and the y-axis here is how much the trade will be worth. So as we see, Tesla stock is currently $418. If it goes up, $420 is still the maximum amount that you can make. If it stays right at $418, $420 is still the maximum amount you can make. And if it goes down slightly, then again, $420 is still the amount you will make. Now, when it breaks below your short strike of $350, that is when you will start to lose some money. So when it breaks below your strike of $355, that is when you'll start to make less money. And we can see all the way from here at $355, if I slowly scroll, you can see you'll make less and less and less. And then your break even point is right here at $350. So if it stays over $355, you'll get the max profit. If it ends anywhere between $300 and $355, it'll be a partial profit. And if the stock price continues to go down further, that's when you're going to start losing money. And you'll lose money all the way down to your long strike, which we selected a strike of $325. And that's when your losses will be capped. But typically you will have noticed that a stock was continuing a downward trend and you would have exited the trade well before it got to its max loss. And also, if Tesla's stock price were to drop below our short strike of $355, then there is a risk of being assigned the shares, which means you would have to purchase 100 shares of the stock per contract that you have. And unless that is something that you're willing to do, you want to make sure that you exit the trade well before expiration. But Tesla is by far one of my favorite stocks to trade. And it was a huge portion of the trades that I made paid in order to build my account. But that is how I have and currently still use credit spreads in order to make a consistent and reliable income. If you would like to learn more from me, make sure you join the Trade to Freedom community. Not only will you get my exact trades when I enter them, but you'll also get my entire options framework via the Trade to Freedom community that will also teach you the A to Z's of options trading. And thirdly, you'll be in a community of other options traders from beginners to experts that have the exact same goals as you. The link is in the description below. Come join us. Make sure you like this video and subscribe, and I will see you guys at the next one. Peace.